Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Friday, March 28th, and I don't often have as beautiful a backdrop. So I'm going to use this backdrop in today's podcast. I'm in the Banff area in Canada on a ski trip right now. It has just snowed. It's beautiful, and but I'm still taking time to deliver a little bit of market information, albeit a day late due to logistics. So let's dive in. Great. So here is our opening. This is a missive from over the border. It's interesting the difference in perspective that can be gained simply from crossing the border into Canada from the United States. And we will be talking a lot in this podcast about some of the unintended consequences of the tariff regime, such as it is. We're speaking a lot about what will happen in early April. And we can look at some of the simple thinking and some of the systems thinking that can go beyond and behind the tariff discussion. As usual, 5 topics to cycle through: inflation, interest rates, geopolitics, equity markets, and a commentary on other asset classes or other aspects. We're going to speak a little bit about capital flows and the dollar today. We are going to also speak about the crisis that tariffs have caused, which is on the doorstep of Canada, as so said by Mark Carney in a speech this week, but is equally on our doorstep in the United States, as this is certainly an upheaval in terms of economic activity, economic principles, economic positioning, and we need to look at how that is likely to transpire for other aspects of the economy and for what we can predict and plan for going forward. April 2nd has been touted as Independence Day, or certainly a date when certain tariffs will come into effect. That is looming right now. I've heard it equally described as a mass confusion day, and we need to look and see whether what will in effect transpire is the same as what we think will transpire, but we certainly know that a sword of Damocles is hanging over April 2nd at the moment. And part of our discussion today will also look at what this means, what all of this positioning means for the dollar and for America first. And we can see that some of the consequences there are not likely to be quite as expected. Last week, we had just come off the heels of a Fed meeting. We were live in Charlotte. We had a great discussion there. And some of the charts I showed are just the first 2 charts at the beginning here. One was just reiterating that the Fed was now deeply uncertain as to the direction of growth rates, as well as inflation and consumer sentiment. There was an element, a dose of uncertainty thrown in there. Some confidence still that no further rate cut was necessary, certainly at that meeting, but there was a lot more dispersion in the likely outcomes. And that, of course, was not a good tonic for markets. They did not react strongly. And I think the sense that the Fed may perhaps not have the same of a crystal ball, or at least guidance as previously, did not instill a great deal of confidence. So uncertainty, yet being data driven, was still the order of the day from the Fed. We spoke also how some of the shift had moved from inflation uncertainty into growth uncertainty, and how I thought that that was actually far more damaging. While in the past we had inflation that was uncertain, some of it been driven by transitory measures, some of it been driven by more structural causes. We were still pretty assured as to growth before. Now it seems that growth is a lot more uncertain. We've seen the IMF projections come down. We've seen Goldman Sachs projections come down to below 2%. And overall, we even saw a negative projection in there by the Atlanta Fed at the very moment of the tariffs being announced. So we also need to look at inflation expectations. They had been ticking up. That is quite well tied to consumer sentiment, consumer expectations. I would still then just plant that seed there that growth uncertainty is now a reality, and that is not good news for markets. If we go to our first finger of the hand, so thinking about inflation, what have we seen this week? We've seen some upside surprise in the US with the PCE surprising on the upside at around 2.8%. On the other hand, we've seen downside surprise in Europe. French harmonized inflation was held at 0.9% year on year, which was below the 1.1% forecast, and Spanish inflation fell to 2.2% in March, below 2.9% in February. So whether this is caused by energy pricing, the fact that we're now moving into the summer and don't need energy quite as much, or there are other factors at play, definitely inflation very much heading in the right direction in Europe. And this has given some confidence that the next move by the ECB could be to reduce rates further. They've already had 6 rate cuts there, so a further cut could be on the cards, which would probably be weakening for the euro. But we need to then combine this with the other relatively positive news flow coming out of Europe, which could have the counter effect on the euro. Back to the US and commodities driving prices. We've seen some stabilization in the oil price, which we'll talk to in just a minute. But we do have predictions around copper hitting even $12,000 this year, say major trading groups. Although we can see shortly that wheat and other commodities, and such as oil, have not been quite as much under pressure. So we do need to look across the board at what's likely to be some of these factors affecting inflation in the US, tariffs, of course, being a huge potential factor, but some of the underlying supply side factors may, in fact, be a lot more upbeat in terms of their ability to keep inflation in check. When we look at consumer sentiment, this has been very much in the news, and it's interesting. There's been consumer sentiment indicators which show consumer sentiment from University of Michigan falling back to levels not yet seen since 2022. But another measure, the short-term expectations for income, business, and the job market. This is where there has been a focus, and we've been looking back not to 2022, but as back as 12 years. And that has been the 12-year low. So even if in the long term, Americans are sanguine or optimistic that the tariffs in effect or some of the very rapid restructuring of the US economy will be good for the US and will lead to more onshore production and industrial renaissance of kinds, there is still a lot of short-term angst. And certainly that's even around the job market and income and business, and probably also around inflation levels. What I've also had used here is a chart of Lululemon. I have spoken before about the K-shaped recovery, how it did seem that the lower end consumer with less discretionary income was struggling a lot more in this soft landing than, say, the higher end consumer. And we discussed it when we were in Salt Lake City about the higher end consumer spending $30,000 on round trip business class tickets to Europe, the demand for cruises, etc., being quite high. I'm citing this Lululemon because Lululemon might be seen to be at the top part of that K. Expensive yoga pants and maybe certain lifestyle choices, definitely not in the essential spending category. They've sounded a warning signal about demand in the US, whereas they have actually got quite strong demand across the globe and are building new stores in China, etc. Their US same-store sales have been falling, and their stock fell by 10% as a result. So another warning sign that even the higher end consumer is starting to feel the pinch today. Moving to the commodities arena, we know that there's generally been oil price moving. It's on the cusp of raising its year-to-date loss. But equally, the $65 is around a floor price for that commodity. Wheat, on the other hand, has been due to a supply glut, but equally due potentially to some upbeat news from Russia, Ukraine around potential resolution there. Wheat has been very much in free fall since the peak was hit in around mid-2022. So that would bode well for the agricultural complex. So a little bit of mixed messages. There's also a sense that WTI, there would be potentially, that would be the focus. The oil price is more of a focus for President Trump than other aspects of inflation, that he believes that the oil price and keeping that low, which we do know, of course, is a function of supply and demand, that could be affected through negotiations, through work with OPEC, etc. And if that is kept low, that may well keep a check on inflation. It is definitely that gas pump pricing that is very visceral, very visible to consumers. So we've got a bit of a mixed set of messages there around oil and wheat. And then just looking outside the US, back to Europe again and into the UK, we saw a little bit of good news on inflation, and the price rises fell slightly in the last month against expectations, which had expected them to rise. They're still somewhat higher than they would have been in Europe, certainly not at the level of France or Spain. But there has been a little bit of sense that the UK perhaps is not as mired in stagflation as had previously been thought. However, the voting machine of the demand for gilts still prices them at around 2 percentage points over and above bunds, German bunds. So whereas all of this posturing US versus Europe has generally been very favorable for Germany, as well as some changes on the domestic front there, we see that in the UK, they've struggled with the current budget. They're struggling with the aftermath of Brexit, and emerging from this stagflationary kind of sense of stasis will be important for the UK to break through to economic growth. As I mentioned before, the ECB now secure in inflation being in check may actually be poised to cut rates again. And this chart here suggests that while when it was looked like there would be more fiscal spending, it did seem like there might be more fiscal spending would take the pressure off the monetary side of things, that the ECB would not have to reduce rates. Now it seems with tariffs on the horizon, and as I will show later, some of those tariffs could be extremely damaging to European economic growth. We will, in the short term, certainly, and even in the medium term, they may well need to utilize the toolbox of monetary easing to tackle that. So again, we're back, it looks like, to an implied rate of below 2%, around about 1.8 in March 27, based on the recent developments there. So definitely heading back down on the interest rate side in Europe. When it comes to markets, we are rounding up the end of the first quarter, and it looks like it will be the worst quarter since 2023. Not going back too far in that instance, but still breaking the record, the nice run that we've had up to now. And one interesting comment made was that still, even though there is tremendous uncertainty in markets around trade, that has still not been developing into much volatility as measured by the VIX. The VIX is deemed to be perhaps a volatility. It is a volatility index, also been described as a fear index. And while that did spike around the first discussion around tariffs, it has been quite subdued ever since. One suggestion is that this was actually more pricing of uncertainty, and that some of the hedging or the protection had essentially already been bought. So whether this is a true measure of the uncertainty in markets and of the perceived risk, or just is reflecting that many participants have already put their hedges in place and are no longer buying protection because they've already bought it. This could be a factor. So maybe it just suggests that while trade uncertainty is riding high, we might not necessarily see that reflected in the VIX. Coming now to tariffs, and certainly with the April deadline looming and the ongoing discussion around now auto tariffs that look like they will be very damaging to the car industry, it's important to what are the most simple, I suppose, the most obvious outcomes of this tariff policy. It's interesting, again, there's been a lot of reference to economic history in past weeks. Very interesting to look back at history and see how tariffs have performed. It is interesting how the Fed had done that in their last discussion. We discussed this last week. They looked at Trump 1.0. They had cited washing machine tariffs, and it suggested that the effects of tariffs were transitory, that in effect the deflationary forces, all of which was enabled by technology, were conspiring to bring prices down anyway, and that initial spike would continue to bring prices down. I think this perhaps is misleading. As I mentioned before, it was an isolated case. There were not as many tariffs in place then. And I would suggest that some of the global trade in place has already been instrumental in getting prices to being as low as they are. And it has been that law of comparative advantage that has led to the rest of the world being able to actually take advantage of their relative advantage and lead to this lower price of goods. A couple of parts of economic history. There was a discussion of the chicken tax, whereby trucks had been attached with a 25% tariff imported pickup trucks in the US. As a retaliation for a tax on US chickens outside of the US. This came from the 1960s. This did manage to keep production within North America, but because of this, how effective this was, it didn't actually raise much in terms of revenue. So again, it would suggest that it was highly effective at this time in getting the industrial production focused within the US, but revenue, it was not so generative. The question again, whether the long-term goal of these tariffs is to generate revenue or to in effect ensure that onshore production. If it is the latter, then this will be supportive of that measure. For now, though, we see that stocks have ended lower after the tariffs in particular had rattled car makers. We have the sense that this will have a direct knock-on effect on the price of used car vehicles, as clearly they would not be subject to the same import duties. That is likely to cause used cars to spike again. And we saw the most spiking there during COVID in the aftermath of the supply chain dislocations. And there is a concern that this, as a barometer of CPI, used cars could well be a very niggling factor that will affect inflation, will be more visceral again, just like food prices, in terms of affecting inflation, at least in the consumer's eye. And I would suggest that this is likely to feed into consumer sentiment as well. We know how essential the car is as part of US culture, US lifestyle. And if we now, as well as identity, and if we now have this used cars also higher prices and the existing auto industry in turmoil, this does not bode well for consumer sentiment. Looking beyond the simple effect of tariffs, there is, of course, the broader systems thinking effect of tariffs. And this is something that has not been modeled for successfully yet, but it is very interesting to think about the unintended consequences of this policy, which is unprecedented in its scope. Firstly, we've spoken before about workarounds, and we know that Chinese exporters are going to be hunting for alternatives for what they deem the irreplaceable US buyer. There was an article in the Wall Street Journal this week. We know that workarounds are already in place and starting between, say, Canada and Europe, its allies there, and perhaps in China on the other hand. We've already had some fairly forceful wording from the Canadian Prime Minister, Mark Carney, saying definitively that the old economic relationship with the US was over. We have heard subsequently that there was a productive phone call between President Trump and Mark Carney, but at the same time, he was quite definitive in suggesting that we would need to rethink these alliances, rethink this economic dependency, and there would be a new regime essentially that would come into effect probably quite painfully, at least initially. We can also look at the effect that tariffs are likely to have if they reach as far as pharma and pharmaceutical exports into the US. Particularly if we look across Europe, the effect that that would have. T.S. Lombard did an analysis of how much a 25% increase in US tariffs would have on the percent on GDP of various countries that export a lot. If basically in Ireland, cars and pharma alone, not a lot of car exports from Ireland to the US, but pharmaceuticals definitely, that 25% tariff could have an immediate 1.6% effect on GDP, which is huge. And if that were to extend to all imports, that would be 3.74. So obviously, this tariff potentially could be devastating for the Irish economy. And if we look across the rest of Europe, it's a lot less of an effect, but still a reasonably meaningful effect of 1% or so across most of Europe, effect on GDP. And this is meaningful, and we need to be thinking about why this may well need to trigger both remedial action as well as potentially retaliatory action by Europe. By the same token, if we look outside the US, and many investors are looking outside the US, things such as copper rallying, we discussed the copper price already, would have a very strong effect on copper producers, such as in Chile and Peru. These would be the typical frontier markets that would have a small allocation for most investors, but they could actually profit quite a lot from some of these inflationary aspects. So for every action, there is an equal and opposite reaction. And I think we need to think very closely to what this game theory could evolve in terms of retaliatory action and what that would mean for the US structure. And it seems that the consumer that is focusing on the short term probably is exactly right in that in the short term, this could be very damaging for the consumer, although in the medium term, there could be perhaps more positive outcomes. We've been asked a little bit about banks, and this a chart here which discusses the performance of shares of Wall Street firms. It's a little bit difficult to see this particular chart, but suffice to say that since President Trump's election, there has been strong performance for banks. Some of this has been on the back of an expectation of tailwinds of regulatory change that was going to be in their favor. We have seen, however, that some of the slackening IPO activity, some of the M&A activity, some of this has taken its toll, as well as the uncertainty in markets on banks, and there has been a bit more of a return to the norm ever since the initial rally of strength in the aftermath of the inauguration. And I'd say that right now for banks, we really cannot speak about banks in the one voice. There is such dispersion between strong consolidated financials such as a JP Morgan that has been performing well, seems to have dominated market share in many areas, and some of the more regional banks that have less perhaps of a reach and diversification of product, more exposure to interest rates, more exposure to property. So a mixed picture, I'd say, for banks at this stage. Moving to out of capital markets, but yet remaining in the kind of other category, there has been some discussion around capital wars and trade wars. And I think this is important because if we look at trade deficits, and there certainly have been trade and are trade deficits in place, and that's whereby the US will import more than its exports to certain countries like, say, China, India, etc., Canada. And President Trump has focused on these deficits as being a source of unfairness and unfair treatment. What there has been one argument suggests that the what has been extracted from this deficit on the other side has been reinvested within US capital markets. We've known that with the dollar as a reserve currency, there has been a captive audience and marketplace for US treasuries. And if we look at the current state of US investment, foreign investment in the US, we can see that that has built up dramatically and is probably at 2024 at an all-time high, certainly in the last 20 years. So if we were to see that this chart on this slide depicts the U.S. net international investment position, so the percentage more that is invested in the U.S. than the U.S. invests abroad. If this were to be reversed, if initially through trade deficits being eroded, there was less money to reinvest in the U.S., that could certainly be a factor. If the perception of the U.S. as being more protectionist and less of a global player, less of an attractive investment area, is perceived, then that could also lead to fewer capital flows. We've also seen there can be some initial wins when it comes to capital flows. We can see bans on investing, say, in China that have come out of some US states. But if we look to and they're essentially quite easy for these to come into effect. If we look at the longer term, these can be quite damaging in terms of just the general demand pattern for US assets. We can see that the US share of global equity market equity cap has recently declined. It had previously been as high as 57%, and now it is down closer to 54%. So still, the lion's share is still the US, but it has been declining as the US market cap has fallen and as the other market caps of Europe and other ex-US regions has grown. This has always been disproportionate to the earnings that US companies represent. US companies have, whereas their earnings share has been steadily growing, it has not kept pace with their market cap share. Earnings share is around 43%. So I would say that that is a sign that there has always been perhaps a disproportionate market cap versus earnings. There is a potential for those to come into line. So some concern, I think, around the potential capital flows into the US. What we read this week also was that while institutions did increase their capital flows into the US, decrease their capital flows into the US, it was actually retail investors that were increasing. So some retail investors on the sidelines seeking to buy in. And this is very relevant for the dollar, because if we have a captive market for buying into the US, this would then, of course, be very supportive of the dollar and very suggestive of the dollar being a strong reserve currency. We haven't heard as much about de-dollarization in recent years. That came up, maybe in recent months. That certainly came up about a year ago. This was a discussion. I think this is a discussion we need to have again, as the deliberate creation of a less globally integrated US, more focused on America first, less dependent on trading partners, in fact, a less reliable trading partner, less inclined to offer defense assistance, and less inclined to offer aid. We perhaps have an entity that is less inclined to represent the currency of reserve for the rest of the world. We've already seen gold prices on the rise, topping $3,000, and that was another record being set there. I would suggest that that is a signal that other central banks are certainly loading up on gold. Is also probably a concern around the debasement of currency. We've seen that as a factor for some time. And equally, the dollar has been persistently weak since the beginning of the year, and suggestion that certainly it could be propped up by a good interest rate differential if the ECB continues to drop rates, if the tariffs have a negative effect on the Canadian dollar, Mexican peso, that could prop up the dollar. But overall, the tariff regime and the isolationist regime is negative for the dollar. So we do see a weakening impulse there. And it's unclear whether the president would want the dollar to be strong or not. So whereas the image of a strong dollar perhaps is a strong one, he knows that a weak dollar is going to be more beneficial for the exporters, the US exporters. So overall, something to watch there in terms of the dollar. There was also a suggestion that even some of the Russian sanctions and the removal of Russian banks from the SWIFT system, again, a political action that was tied to sanctions, that drove a desire to hold more reserves in gold. So quite a complex web around the use of the dollar as a reserve currency. But perhaps as America is making fewer friends on the foreign stage right now than perhaps enemies, it could well be something that is something to watch. Last week and weeks previously, we mentioned Trump put, or a pain point in markets. A lot of discussion this week that it's not so much a Trump put as a Bessent put, and we're focusing on the wrong thing by focusing on markets. We should instead be focusing on 10-year US Treasury rates. That is the point where there will be a suggestion that that's the focus, that keeping that at a reasonable level is more important than the movement in markets. I think that may be slightly myopic in that we do sometimes forget just how dependent Main Street is on Wall Street, particularly with retirement plans invested in equities. So I'm not sure yet where the Trump put stands, but sufficient to say that it's getting a lot of discussion and a lot of suggestion that the markets do not matter to the president this time around. We spoke last week about some of the challenges in geopolitics, and certainly in Turkey, we've continued to see the that royal markets there, and equally in Indonesia, we've seen drops in the rupiah. I would just have called this captured. The signal is the noise. We did see discussions around war plans being discussed on Signal in a way that was less appropriate for classified information. So more noise, I would say, but then a little bit of a pun there in terms of it being Signal that was the noise. And just two other points to note in the background. We've spoken in the past before around AI and the kind of the picks and shovels aspect of AI, whereby the infrastructure would be supportive, and how we could look at AI as potentially just one angle to the general build out of support around that. There has been a little bit of a warning sign. This is not the first time suggested around the data center build out. That this time it came from Alibaba. We've seen it come in the past from Microsoft. And finally, a CoreWeave IPO was touted as being heralding a return of the IPO market. It didn't raise as much as it had intended. It had hoped to raise 4 billion. It only raised 1.5 billion in a scale back IPO. This comes from the Financial Times. The previous headline comes from Bloomberg. And it suggests that the IPO signaled a lack of enthusiasm around AI. So that is it from beautiful Banff for this week. I will be returning for another live podcast in Dallas next Thursday. It's April 3rd. If you are in town, please get in touch. We'd love to see you. It's been hosted at Old Parkland, a glorious venue that is going to be fantastic. And then on the 10th, we are in Baltimore in Towson University, another glorious venue, which will hopefully attract both a number of students from Towson as well as a lot of our contacts in the Baltimore area. So look forward to seeing you both hopefully there. It will certainly be live and broadcast on YouTube right after. Thank you, everyone, and have a great weekend.